Welcome back to the Williams Real Estate Channel. Today we are running through the macro market update for January 2025. I'm doing something a little bit different this year. I'm breaking up our property market update, our monthly property market update into two. I'm going to do a macro market update, which is this one. We'll start with this, and then in the next day or so, I'll roll out the property market update once the small data is released. But I thought I'd break it into two as the slideshow was getting too long, and best to start with the bigger picture first, see what's going on in the economy, in the world, what's happening over in the States as the States leads the global economy. And then we'll dig deeper into how it will then play an effect to the Australian property market. So strap yourselves in. There's a few slides, a few key data points that I'd like to discuss, which is all around providing context to where we sit in the market based off the 18-year land cycle. If you haven't been following me, quick market wrap of or explanation of what the 18-year land cycle is. It is an underlying rhythm that has been happening since the 1800s. Research it, look into it. But basically, it consists of 14 years of expansion and 4 years of downturn. And the 14 years of expansion is interrupted with the mid-cycle slowdown. The last was COVID. One before that was the dot-com bust. And the one before that was the early 80s recession. And the large land-driven downturns that come around every 18 or so years consist of the last one we experienced was the 2008 GFC. The one before that was the 91 recession we had to have. And the one before that was 1972. So we are on the blue marker coming into the peak of the market. This is the peak global market. When we talk about land drives the economy. It all comes down and filters down to land. So we are on the blue marker, equivalent point of time, June, mid to late 2025, mid to late 2005 in the prior cycle. So we are just entering 2025, obviously, and I believe this is where we are heading. And based on if we start the 14 years of expansion from 2011, would bring us to 2025, or if you're starting it around 2012, will bring us to 2026. So it could be any time now. We could be in the eve of the next inevitable land-driven downturn, which is due come 2027. You'll know about it. So this is the few slides which I'll run through of how I believe we are sitting in the market in the point right now, 12 to 18 months before we could experience the next global financial crisis. So first half of the cycle, Sydney, Melbourne outperform. Second half of the cycle, Brisbane, Perth, Adelaide outperform. And the regions have a knock-on effect out of their respective metros. So New South Wales and Victoria regions typically perform in the midsection as people get priced out and then decentralized from those metro markets. Same goes for the regions in Brisbane or in Queensland, WA, and South Australia. They then start to have a good run after their respective metro has had a solid run. So we use it as a framework, and the next market update, I'll go into more detail around how each market is performing, but we use this as a macro framework to work out which market is best to buy in for the future years ahead, because we are no longer buying in Brisbane, Perth, Adelaide, or the regions, because the market is due to turn, and then they will no longer be the best performing markets in 5-10 years. Sydney, Melbourne will be. So that's the framework. How to give you more, I guess, confidence or belief that I believe we are at this point of the cycle is due to the following. Firstly, we have the Australian inflation rate is coming down. The trim mean is down to 3.2%. The all groups CPI is down to 2.4%. However, the RBA uses the trim mean inflation rate, and that is still sitting at 3.2%. So What this says is there's still a lot of work to go because they have a target of 2 to 3 or 2.5% for the inflation rate before they will then look to drop the interest rate. So it is moving in the right direction, but there is still uh, further work to go. And based off the commentary from the RBA, they do not expect the trim mean inflation to be consistently held within the band until 2026. So if you can overlay that on the 18-year land cycle, you'll know that come 26, we'll be well and truly hitting the peak of the market. And once the market turns, inflation will be well dropped, and then they'll panic and probably drop rates back down again. So another thing that the RBA continues to keep an eye on is the unemployment rate. It is starting to trend upwards. It's sitting at 4% as of December 2024. And if this starts to run, which I believe it will in the coming year or so, especially once we hit 2027 and the land driven downturn comes into effect and people or businesses are making people redundant to shore up their balance sheets, this unemployment rate will start to run, and that will be a leading indicator that we are entering the next land-driven downturn. So I see it continue to slowly trend up, and then at some point something will break in the economy, and then it will just run as the sentiment will shift to being very negative. Businesses will then start laying people off, and the unemployment rate will spike up to 10%. Historically, in land-driven downturns, they can reach 10+%. So this is another thing that the RBA is keeping an eye on, whether or not they're being too restrictive, and they will drop rates once this unemployment rate starts to really run higher. So we touched on it, but the RBA maintained the cash rate at 4.35% as of December. Their next meeting is in February. I think it's next week or the week after. I'm expecting them to hold the cash rate. I don't believe they'll drop it. I know there's a few people out there in the mainstream think rates coming down as inflation's coming down, but based off what we're seeing in the States, it doesn't look like they're coming down. And based off the commentary that Michelle Bullock is saying, that they don't believe the trim mean will be maintained within the band until 2026. They won't be dropping them early. They're very conservative, and they're not using the 18-year land cycle as a framework. They don't have that foresight of the future years ahead of the inevitable land-driven downturn that is on the horizon. So they're only looking at the last couple of months of data, and they will drop it very quickly again once the market turns and it becomes well evident that we have entered the next recession. So another thing that gives me the belief that rates aren't going down anytime soon is we are in that similar point of the cycle of 2005, and in 2005 they remained steady on hold for a period of time as we recovered out of the dot-com bust, which was 2000, 2001. And we are in a similar point in the cycle here in 2005, and look what happened. They stayed on hold, and then in the last year or two before the GFC in 2006-07, they then again aggressively put the rates up. So that could potentially happen, especially if inflation gets away from us again. But I believe they'll more or less probably stay on hold until we enter the land-driven downturn come 2027. They might go up one or two times, but I don't see them dropping the cash rate down at this point until 2027, because if they did, then that would only be inflationary. They'll provide mass confidence into the market, and that would set off another wave of inflation. So I believe the cash rate's on hold. You'll hear otherwise from the mainstream media and the banks, because they are not factoring in land or using the 18-year land cycle as a framework. They're only using labor and capital in their economic equation. So time will tell, but I believe the cash rate is on hold for now. Stock market's hitting all-time high. So I mean, this is by no means financial advice, as I'm not a financial advisor, but this is my story of what I believe is happening in the market and what I'm doing. I've moved all my super into cash. As of yesterday, I was in cash in June, July 2019 before the COVID downturn, where the stock market took a 40-odd% correction. So yes, you may think it might be early, but I would rather not lose, 20, 30% if there was a Black Friday event, which could well easily happen, like what happened in 1987. There was a 20, 30% correction in one day. So that could happen. We're hitting all-time highs now. Everything's becoming very overpriced if you look at the PE ratio, and I'm starting to stack cash. So that's what I'm doing. As yes, there will be probably growth in the market, but I would rather protect the downside than having potential another 20, 30% upside in the next year to 18 months, because the stock market, you never know, it's very sentiment driven. It could correct very aggressively very quickly. And I'm getting money ready to set up a self-managed super fund anyway, and to buy a block of units. So that's me. I've moved into cash for the years ahead. And even having it in cash, you still make 5.5% return anyway. So it's still a decent return being in cash. The golden age has begun. Trump has not wasted any time and has signed off more than 300 executive orders, which is a record in the States. Key executive orders that will impact the markets include closing the borders, southern border, which will actually reduce migration. So that will slow the US economy, even though, I mean, he's doing it because of crime and other reasons, but ultimately they'll reduce the amount of population growth in the US, so that will slow the economy. Drill, baby, drill. So he'll flood the market with oil. His ideas around that is to reduce oil price, which factors into all types of transport and manufacturing to reduce inflation. Tax cuts, that will be inflationary. They'll give people more money, so that will be inflationary. He wants to make the US the crypto capital, so he's getting everyone excited. Speculation is starting to kick into overdrive. That will be inflationary. He's demanding the Fed to drop the cash rate, so that'll be interesting how that happens, how that plays out over the next year or so, as they are reluctant to do so, but we'll get into that in the next slide. But if that happens, if the cash rate does come down, if he ends up sacking Jerome Powell and drops the rates some way or another, that'll be inflationary. And he's applying tariffs on other countries around the world. So that will be also interesting to see how that plays out. So interesting times ahead. See what happens with the years ahead. But I wouldn't be surprised if inflation kicks off again, and because his policies are very growth driven, and he doesn't even mind inflation, because inflation is actually good for property owners. It inflates the value of your asset and it devalues the debt. Obviously, it's not good for lower middle class who don't hold property, as the value of their cash gets eroded and the cost of living goes up. But those that hold property and hedge against the cost of living will become wealthier, and their debt will become worth less. So he doesn't care about if inflation does tick up a bit. Ultimately, he just wants the cash rate down to create a booming economy. As you can see, inflation in the States has begun to run again, and I wouldn't be surprised if this continues. The Federal Reserve in the United States also has a target of 2%, and they're well above it at 2.9 as of December. So it'll be very interesting to see if this continues on its trend, as it won't allow the Fed to drop rates if they're trying to get inflation down to 2%. And I don't believe it will get down to sub 2% until we enter the next land driven downturn anyway. So it will be very interesting times ahead, but don't expect the Fed to drop rates which will then have a flow-on effect around the world because they haven't got control of inflation yet to below their target. Another thing that the Federal Reserve is also keeping an eye on is the unemployment rate. And as you can see, it is starting to trend up. And based off history, every time it has trended up, it is then run. That was the 2008 GFC. This was the 2000 dot-com bust. This was the 1991 recession we had to have. It's only just starting to trend up. So history doesn't repeat, but it rhymes. And as you can see, we are in the eve of the coming downturn. Everything is shaping up to be looking like it. So the Fed, the USA Federal Reserve, has kept the cash rate or their cash rate at on hold at 4.25% to 4.5%. They have made note that the US economy is still strong and is in an expansionary phase. Inflation remains higher than the 2% target, as I showed you in the previous slide. They're waiting to see what Trump's new policies, including drilling oil, tariffs, tax cuts, how that will impact on the inflation rate, as they are not in any hurry to drop the cash rate further at this stage. So they've got the cash rate on hold, which is restrictive, but they don't have a choice to drop it as the inflation rate continues to increase over the last 2 or 3 months. And they're waiting to see how Trump's new policies will filter through the economy and global economy and how that will impact on inflation. Trump's said that he'll keep inflation low, but that was a different point of the cycle. That was during the recovery phase, or to the tail end of the recovery phase prior to the mid-cycle slowdown. Now we are in the land boom. This is a different part of the economy, or the different part of the 18-year land cycle, where credit starts to kick into overdrive, speculation starts to kick into overdrive, the land boom is in full swing. So we are in a different point of the cycle now. So whether or not his policies back pre the mid-cycle slowdown may have kept inflation down at that point of the cycle, whether or not that will do the same in this point of the cycle is yet to be seen. But I wouldn't be surprised if inflation continues to be higher for longer until the market turns come 2027. Copper remains high at an all-time high. Dr. Copper is a phrase that is used. Copper goes into everything: electronics, manufacturing, construction materials, running cabling, cars, new homes. So when copper price is high, the economy is strong and growing. And when it drops off a cliff, then it is evident, like it happened in 2008 and in the the COVID mid-cycle slowdown, that is evident that we're entering a recession. So it is still high, it is still in demand. So that is evident that the economy is still strong globally and in an expansionary phase. That's then flowing on to the US stock markets. This is the Dow Jones hitting all-time high, almost going vertical, which is never a good sign. So speculation is definitely in full swing. People are plowing in, pushing up prices, pushing up price to earnings ratios. So everything is becoming well overpriced. Bitcoin, all the Bitcoin gurus, all the crypto kings are coming back. Bitcoin's sitting at $168,000 US Australian dollars a coin, all-time high. And what's interesting, it's never been tested through a land-driven downturn. So 2014, as you can see, it'll be very interesting to see how the crypto kings go through the next land-driven downturn. Personally, I mean, again, this is by no means financial advice, but I don't believe in crypto. Yes, you, I guess, may make a quick buck in the short term, but once the market turns and people need their money and there'll be more sellers than buyers, it'll probably go to zero. Like a classic Ponzi scheme works. If there's nothing behind it, if there's nothing that you're actually invested in terms of a property or shares in a business, it's the woozy wuzzy blockchain that no one really seems to understand or properly be able to explain. It's pure speculation. So yes, it may continue to run in the short term, but once the market turns and people need their money to pay down debts, if they've lost their job and they're about to lose their house and they need the money and they're selling and there's lots of people selling and there's not enough buyers, it'll probably get wiped out. Whether or not Bitcoin will get wiped out, time will tell, but most coins I reckon will get wiped out, and I wouldn't be surprised if the whole market gets wiped out. And this could be the catalysts or the weak point that could set off the next collapse or be the weak point in the economy is all this money and funds being invested into this stuff, which really there's nothing really behind it. Warren Buffett has sold approximately 50% of his portfolio, has never done that before in his entire career. The most ever cash he's ever sat on is 25% of his portfolio, which I believe was in the late 60s before the early 1972 Land Driven Downturn. In the GFC, I believe it was only 3 or 5% cash. He's always about buy and hold, investing for the long term, and he's gone against that. And he's now sitting on 50, or he sold 50% of his portfolio approximately, and he's sitting on 325 billion in cash. So don't listen to what people say, watch what they do. Writing on the wall. He sees the writing on the wall, and he also does not support crypto and thinks it will end badly. So when one of the biggest investors in the world is selling up half of his portfolio and sitting on cash, that should tell you something. You can see the writing on the wall. Another thing that really spurred me on actually this week to move all my super into cash, and over the next year or so, I'll start selling off all my stocks into cash as well, was the 10-year and 2-year treasury. This is called the yield curve. Look it up, but basically every time the yield curve goes negative or inverts, historically, it has been a leading indicator for a coming recession. So in this is prior to the GFC, it inverted, and that's the GFC in 2008. It inverted again in 2000. That was the dot-com bust. Sorry, it inverted slightly in 2019, September 2019, and that was the COVID recession, GFC, 2000 dot-com bust, inverted, and that's the 91 recession we had to have. And this is the recessions of the early 80s. And they say that the bigger the inversion, the larger the coming downturn will be. And look at the most recent inversion that started in September 2022, and then again went positive only in September 2024. So it could be any time now, really. And if this starts to run high, like what it has done in history, then that will then probably be the starting point of the next recession, which is the next land-driven downturn. And every second land-driven downturn is a big one. So Australia was lucky enough to sail through the GFC. We had China there backing us, propping us up. We didn't sail through the 91 recession we had to have. So every second land-driven downturn is a big one. It's going to be like the 91, like the early 90s. If you're in your 20s and 30s, ask your parents if they held property, how they went through the early 90s. Great buying opportunity, getting great deals if you're buying the right product in the right market at the right time, but not if you're buying in overheated markets and buying new and off the plan stuff and paying over the intrinsic value. So this is the most pivotal point of time in the cycle right now. Be very cautious who you listen to and be very cautious of the asset and the market that you buy into. This is also another metric I use to work out where the market sits. This is one of the largest home builders in the US, and based off history, their stock price started trending down come 2005, come 2007, October 2007, the whole market collapsed into the GFC. So it has started to trend down. It's already lost 30%. If this continues, which I suspect it will over 2025, it could be the leading indicator for the coming downturn come 26, 27. So time will tell, but I'm keeping a good eye on this stock price along with other smaller home builders, but this is the biggest one that I like to keep an eye on. Just a bit of housekeeping. This is by no means financial advice. I've already said multiple times before, but you guys get it. This is my story. This is my thoughts. If you have any questions, if you need help, shoot me an email, provide me feedback, send it to anyone you think is of value. Like, subscribe, share, comment, do whatever you got to do. Hit me up if you want help buying your next investment property. I operate as a buyer's agent to buy investment grade property, and I can help you navigate through the turbulent times ahead. It won't be all sunshine and rainbows in every market. There's only certain markets and certain suburbs, less than 20 suburbs, and only certain types of products in terms of property that I would be buying right now that will perform throughout the next downturn. And it is not Brisbane, Perth, Adelaide, and the regions. Don't go buy regional houses. I'll give you one hot tip. Those that are booming now will not be booming in the years ahead, and you don't want to be left in negative equity and lose your job and then have the bank knocking on your door asking you to pay down the debt. And if you don't have the cash, they'll be selling it. So don't get yourself in that situation. If you need help, reach out. I can run reports to show you where your property sits in the market and how you may want to best play your future purchases in the years ahead. 10 properties in 10 years. That's what we specialize in, building solid residential foundation portfolios that are self-sufficient and sustainable for long term. Until next time, I'll catch you on the next one.